Hello, today is Thursday, the 21st of February, 2008. This is Brian Shannon speaking from Alpha Trends, and the market's closed. And we had a resumption of selling today as the S&P 500 spiders closed with a loss of $1.45 or 1.07%. And the market continues to coil tightly, more tightly that is, within this symmetrical triangle that I've been pointing out for the last week or so. You can see we're back to right about the midpoint of that, coming down actually a little bit closer towards the end of it. And as I pointed out on my blog earlier today, typically these patterns are resolved in the they're considered a continuation pattern, which means that they're resolved in the direction of the primary trend, which obviously is lower here. So the odds favor further downside. We were looking for the possibility of maybe a little bit of a short squeeze rally if the market was able to get above 137.20. That failed to hold, so that never materialized, and now we're back down towards the important level of support that we've been seeing develop over the last week, which is at 134. When we look at the let's look at let me just back this up to about 30 days worth of data, and we can see this pattern developing. That is the symmetrical triangle a little bit more clearly. Now you can see we took out the upper end of that, and a lot of times what happens is we get a false move in the opposite direction of the primary trend, which would occur with the breaking of this little downtrend line that we see here developing. But the failure to make a higher high gave us no reason to basically get involved in the long side for a potential short squeeze rally. So now it looks like this market, is kind of reaching critical mass. These patterns typically resolve themselves about 50 to 80% of the way towards completion of the triangle. So we're right in that area where it ought to get resolved. And the way that you look for a price objective is you measure the height of the pattern, and I like to do that pretty conservatively and subtract it from the place where it would break down from to come up with our price target, which would give us basically a test of the lows near about 128 or so for the S&P 500. So there remains a lot of reasons to be concerned about this market, and if I clean this mess up in here, you'll see that again. Well, let's look at the 10-minute time frame. That we've got that 5-day moving average declining once again. Yesterday I had said that the 5-day moving average was kind of neutral and not really giving us any reason to get involved with any conviction, long or short. But now that it's declining once again, it's telling me that the sellers are getting more aggressive. The more time support is tested, the more likely it is to fail. The people who've been defending this 134 level are, running out of patience, maybe running out of cash in here, and the odds just favor further downside. If we take a look at the another reason why this level is important is, again, this if we take since the Federal Reserve began cutting interest rates more aggressively with that 75 basis points, and then the 50 basis point cut right at this point right here, you can see the average price that this market has traded at is about 134.40, right about where we are. So breaking below here would essentially put the average person, since the Federal Reserve cut rates right in here, the average person would be losing money underneath that level, and then I think you will get a bigger emotional give up in this market. And what we have here is just a tightening of the volatility, as people just generally don't know what to do in this market, and the break lower from this symmetrical triangle could lead to a lot of emotional, frustrated selling. Something that I've been mentioning on my blog is this Harry Newton, and you guys got to read this thing, I think, every day. He's got really some good stuff going right now in particular about this auction rate securities. Read his column. Here's an individual who they sold these as cash, and he's down $4.5 million. Can't get a bid on these things. He paid $4.5 million for him as an individual, and they're used heavily by corporations who need that money. They're not finding the liquidity for it. If you think of an individual who's not finding liquidity for $4.5 million, it's the same situation. This credit crunch stuff, you've got to understand the psychology of the market and the fundamentals that drive them. I know I don't talk about that a lot, but where are these people going to come up with liquidity to pay their bills and to pay their taxes and that sort of thing? If they're not finding they're not finding liquidity in the interest rate markets, then it becomes a natural place for them to sell their equities. Now, that's not a reason to go out and sell short, but it's a reason to think that the psychology could end up in some real frustrated selling here. Wait for the evidence to be confirmed by price action before you take any action to buy or sell, though. Only price pays. All that other fundamental information is good backdrop, but don't let your beliefs get clouded by what price action might be telling you. Although in this case, it appears as though the fundamentals are confirming what the price action is telling us, obviously. The semiconductors are back to their 5-day moving average. The 5-day moving average is declining, so we've got still a big mess in here. It's it's coming towards the end of towards that later than midpoint where this symmetrical triangle ought to break down further. If we take the height of this pattern right in here, and let's just go even a little bit more conservatively and measure it right here at this point. If I grab that line and take it from the breakdown point, that would give us down near about 25.5 or so. So there's still the potential for a lot more selling in this market. The IWM, Russell 2000, I've been talking about this one, is this has the most defined trend line in here. And this symmetrical triangle is also, we're finding a very nice, and actually, this is a classic textbook pattern. Now let's see if we get a textbook resumption of the trend lower. That you can't take any technical pattern or indicator blindly by itself, but it sure does make a good case for further downside in here as this pattern continues to coil tighter and tighter. We've got this downtrend line. The market did get above 71 today, but where did it find resistance? Right at that downtrend line once again. So it's looking like this market is inevitably going to decline. We've got this level here at about 67.75. I think is going to be important as well. So maybe we get, ideally what I'd love to see would be maybe another rally up towards 70 tomorrow, and then they crush them. That would be a great way to get aggressively short during the course of the trading session. And again, the way to do that, I think, is with the TWM, the double inverse ETF for the Russell 2000. You see the range tightening in here. And again, if we take the height of this pattern, let's take it from here and add that to the breakout point. That would give us a price objective up near about $95 a share, and here it is at just 83. So if these patterns do materialize, and we're going to need to see price confirmation. Just looking at a pattern and studying a textbook doesn't help. Understanding the psychology of what creates this pattern and what creates the frustrated give up if and when this market breaks below this level. And again, here, look at how this market just sold off all day long. That's just some consistent, steady pressure applied to this market all day long. Big volume at the end of the day. Breakdowns don't typically occur after an extended move lower like this. So we saw a 2-point straight sell-off. Typically, they'll get a little bit of a bounce and then decline. Typically, but it doesn't mean all the time. Nothing is guaranteed to us in the markets other than volatility, and that's why defense is what wins the game, and that's got to be our #1 concern, is preservation of capital. The NASDAQ 100 was down 42 cents today. This market failed to make it above that 44.50 level that I was mentioning yesterday, saying that if it got above 44.50, then perhaps we would see the possibility for some further upside in this market, but that didn't occur. The high in there today was 44.47, so it came up to the top end of this range. Now we've got a declining 5-day moving average again, and it just seems as though the pressure is really building here. We're back to that 43.50 level. I think that yesterday's lows, though, are going to be more important as far as where a give-up selling pressure comes in. That's about 43.20. If we take a look at the average price since the last 2 interest rate cuts, you can see that this market is the one that remains below that most often, and there's more frustrated owners of stock, I think, in the NASDAQ than there are in the S&P that's just kind of holding on to that level. And if we take a look at the average price here in the IWM, you can see I just took this line, went directly across, and we're basically there again. So these markets are at very important points, and there's the potential for a quick move. I think it's lower, but I'm going to be prepared to go either way. The odds certainly favor further downside, but it looks like it's about to get really interesting here.